looking at just a bit over 24 hours after the Fed. The dust is settling. The markets are picking a direction. Gentlemen, what make you of all of this?
I mean, it kind of came in as expected for the most part. The initial reaction was a sell-off. I went ahead and got long when the NASDAQ dipped around 24,400, sold a put spread at 24,000, and I did it in the 1 day, so it worked out there. I think now going forward is a little more uncertainty. You know, Powell stating that both sides of the mandate are potentially can be misaligned going forward this year. I mean, we got the one dissent that was a given for the 50, but I think it's going to be the same story going forward, data dependent. I think it's going to depend on the news. Inflation comes up, you're going to be looking at, you know, more risk in the market. Labor market goes down at the same time. That complicates the Fed's path. So I think we have to take it week by week here, looking at data points, and it might be potentially more volatile going forward.
Yeah, I think so. Let's take a look at the charts here. I think probably the most annoying of the charts for those of us that were short the S&P going into this is this right here. So here's the Fed, and Thomas, to your point, the initial reaction is negative because I think we can surmise here that all of what the signaling was besides the cut itself was on the hawkish side of what the markets wanted. And I think you can see that with the naked eye, as it were. I'm just going to see if I have the Fed forecasts here. I do.
What's the alternative to the naked eye?
The eye covered in glasses, I suppose.
Okay.
I suppose, as you see demonstrated here.
I mean, you know, corrected vision might be considered a preferable alternative to the naked eye,
if one needs one's vision corrected. If one's vision does not need correction, then all you see is a blur, and that's a whole other situation. What you can see here clearly is the revisions to GDP growth. They're not down, they're up. They're up for this year, they're up for next year, they're up for the year after. The only revision that you see in the forecast for unemployment next year, the year after, it's for unemployment that's lower, not higher. For inflation, only one adjustment for next year, and it's higher. So the Fed comes out and says, yeah, here's your cut. Whatever. You knew that was coming, but everything else we are going to upgrade to more growth, more inflation, and a better job market. Okay, what about rates? So the baseline here is a little bit different now. The Fed basically says, okay, the market's already priced in 3 cuts. We will endorse this. Congratulations. Even though it was very narrow, by 1 vote. Guess whose vote it was? You see this lonely dot down here?
I do.
Guess who the tiebreaker was?
Can't say.
Yeah, between 2 cuts and 3 for this year. But the market's already had it in the forecast at over 80% for both of those cuts, October and December, a week before this Fed meeting. And you can see it here. So here is, there we go. Here is October. This is a week ago, over 80%. Here's December, a week ago, over 80%. It's not like the markets didn't know that this was going to happen. So what did the Fed do here? It just acknowledged what the markets already knew, but then still only 1 rate cut for next year, only 1 rate cut for the year after. That's at least 50 basis points removed from where the markets are. So this sounded hawkish. And so the dollar is up, yields are down, or bonds are down, rather. Yields are up, gold's down. All of those elements of what we'll come to call the Radigan, all of that is still there. I mean, you can clearly see it. Here's gold. It's down. That's not a dovish.
Gotta love the short gold, long dollar, but not satisfied with the Nasdaq's performance as it comes to the Radigan. Speaking
Well,
of,
and this is the interesting thing. So all of the hawkishness here seems to be existing in all the assets except stocks. Stocks seem to have a very different view on all of this. So here's the dollar. It's getting stronger.
gotta love it.
If you want to look at the dollar index, we can look at an average of the dollar. There it is. It's up.
Gotta love it.
If we wanted to look at what the bonds are doing, bonds are down, yields are up. So I can only surmise that what all of this means is that the markets have looked on upon the Fed's forecasting of faster growth and faster inflation and lower unemployment and said, they have decided that they're not going to continue to try to save the White House from itself. And they're just going to say, you know what? F around and find out. You want to run this economy so hot that inflation kills consumption? Go ahead. Run it hot. See what happens. And stock markets said, okay, I guess we're going to run it hot. I guess growth is going to be faster. I guess inflation is going to be faster. I guess asset valuations on the risk side of things are going to be higher. And so NASDAQ seems to, I mean, we have it here with the naked eye, as it were. It's going up.
I find it agitating and perplexing and somewhat dismaying.
It is all of those things. What it is from a price action perspective is closing above the swing high here, and so making a higher high and basically saying, I'm resuming the trend. I'm going up, which interestingly, Thomas, is not what you have in the S&P. You try to make a new high and then you fail. Does this tell you anything, Thomas, about maybe there's something under the surface here? Maybe the market is still attempting to think about what it thinks of the Fed and still deciding, or have we already decided?
I mean, yeah, staples, discretionaries, energy were the only real three losers today. Technology coming in really strong. I think this is the NASDAQ making new highs is speaking to the economy is going to be run hot. These companies are going to be able to capitalize on that growth better than others. But I mean, the S&P 500 wasn't the vehicle that I wanted to get long in yesterday. It was the NASDAQ. I think that would have had the best reaction. It's been the leader. I think it'll continue to do that. But you also had a lot of strength in the Russell. So, I mean...
You did, yes.
It's, the Russell, a lot of regional banks, of course, it likes lower rates. If you're thinking of a hotly run economy...
This is the run it hot prime example.
This
is like the cyclicalist of the cyclicals.
I mean, it goes back to what I was saying on Tuesday, that the risk isn't in the short term. It's possibly next year when, if you let this economy run hot, the difficulties with the dual mandate that Powell mentioned is going to come in the form of hot inflation and, it's a still weak labor market where those mandates are conflicting and they have to pick one to address. So for the time being, they're focused on labor. Of course, that the labor market got weaker and we got the cuts. Inflation is still above target. So I mean, it's next year, I think, where the real risk comes. And I think the market is going to continue to just grind higher for at least a few months. I mean, the rate cuts are here, they're coming, but what comes after that? What are the consequences of once these rate cuts start to bake into the economy next year? So the way I'm going to be playing this is taking my shots on the long side. On dips, I'm going to be selling put spreads and mainly playing it through that, giving myself a little bit room on the other side, doing it with short-term expirations, possibly as low as 1 or 0 days. And, I've done that in and out over the past few months. It's worked. I'm going to continue to do that.
Mm. Mm-hmm. Yeah, I mean, it's a very interesting thing here. Now, are you going to in making the assessment that, okay, you know what, they're going to run this thing hot, it's going higher until it isn't. Who knows where it ultimately wipes out? It will wipe out eventually, but this is not where that is apparently. So, how do you structure that then? Are you shortening duration or extending duration? Are you saying I'm gonna approach this in the Russell, or you're gonna stay in the Nasdaq? Are you picking individual days?
I'm going to stay in the NASDAQ. And the reason I'm doing short duration, which isn't like I do in other assets,
Right.
is because you get these big moves up after these dips. And, the moves higher are pretty quick off these dips. So they get bought up quick. And if you could get in and out of these positions, without waiting weeks to take it off, I think that's the way to go. It's like I said, it's been working for me, so I'm going to continue to do what's working.
It makes sense to essentially say, well, you know what? I'm not going to make a great big bet on what the trend is. I'm just going to make a bet that the market at this point is so conditioned to buying the dip that even if eventually it's wrong, you'll get that initial rip from a dip. And if ultimately you get the big one, it'll be after some initial reaction, and hopefully you're already out of there by then.
Yeah, and I mean the labor market's interesting right now. It's like, we don't have hiring, but we don't have many layoffs yet. It's kind of stagnant. Right. It's stagnating, and is one cut going to inspire enough confidence in these companies to start hiring right away? Probably not. I mean, so we're probably going to see the labor market continue to not drop off a cliff, but just continue to stagnate. So, I mean, once you get 3 or 4 rate cuts in and you get the labor market starting to recover with inflation already above target, then there's more demand in the economy, more people with jobs. What happens to inflation then? I'm presuming that inflation is not going to get down to target. And next year, we're going to see it start to rise more. And there's arguments, have the inflation impacts been baked into prices all the way? I don't think necessarily yet. I think that's going to take some more time. But I think the risk to the market in terms of headlines and, trade war headlines, I think that's largely off the table for now. So I think it's going to be something that, we're trading less headlines going forward, and we're trading more data.
It certainly seems like the game now, to your point, is okay, we're going to run this thing hot until the heat of the inflation starts to really beat down consumers. And we already have this weakness. Powell talked about it in what happened with consumption in the first 6 months of the year. It was a terrible 6 months for consumption, the worst in 5 years. 5 years before this year, of course, was the COVID lockdown. So not a happy reference point. So we already had weak consumption. If we look at face value, let's say the retail sales numbers this week, they were fairly okay. Mostly because of e-commerce, mostly because of purchasing up market. But down market, there's a lot of strain. And we can see that, we can certainly imagine that by the time we get to third quarter GDP data, those consumption numbers are going to look weakish. And then going into the fourth quarter, weak, because all of that inflation really starts to build in its cumulative effects. The goods inflation side, and again, Powell talked about this in the press conference and pointed out goods inflation, as we've been pointing out, is at the highest in 2 years, and that's not negligible. That's not normal. So you have a situation where ostensibly this will come together to crash growth and basically overheat the economy eventually. But the question is when does eventually come? And in the meantime, you're basically one bad data point away from saying, "Oh, we've arrived. Here is eventually." But until you get there, you don't really have any reason to think that you finally had one shot too many, as it were. It's one of those things where you know the line when you cross it.
Yeah, I agree. And I mean, you look at regional banks, they did really well today. Of course, they like those rate cuts. But I still think there's two different economies right now in America. And I think that's why technology has done so well. There's still investment, there's still capital spending. I mean, there's still a lot of this AI hype. And, you know, I was a little surprised to see the Russell perform so strongly today. And I think it's the banks that are reacting to that. I think without the banks, the Russell wouldn't have made that move. But I mean, it's
probably not.
It's you know, I have less confidence in the Russell going forward than I do in the NASDAQ. So I mean, I look at the Russell, but I don't trade it.
Yeah, I mean, if we look at where we did the best here, just looking at 1-day performance, I mean, obviously, tech absolutely killed it, and all of the weakness today seems to be on the defensive side of things. But it isn't just consumer defensive that had a big hit to performance. It's also consumer cyclical. It's also energy, which is interesting in the in context here, because it does seem like the market recognizes that running it hot is not a good idea, but also that things like tech aren't so cyclical, and until there is a real hit to underlying demand, they can just run for no reason other than there isn't a bad reason. Which is a kind of it's a kind of crazy thing. Is there anything that interests you, gentlemen, on the bond side of things? Because this now is a very curious chart, and what I'm seeing here is a trend that's going up, a pullback into former resistance turned support, and a sense that if the Fed is really of a mind to cut rates, but it's not going to go big now because it hasn't seen sort of the boogeyman of growth here. It's upgrading its forecasts and whatnot. That this means that rate cuts are going to keep getting pushed out, and so the yield curve maybe twists, and so you get fewer cuts up front, but more of them later, and maybe this is a buying opportunity.
Yeah, I think this is a buy when ZB drops just a little bit more. I have it marked as the 21-day EMA, which is right under where the lows of the day were today. I almost bought there. I held off on it. I mean, you look at this compared to June. So the median expectation for the rest of the year is 2 cuts, but you had 5 or 6 policymakers, you know, say no more cuts this year. So the market got really priced into this rate cut that happened this week. But I think there's less certainty on rate cuts happening this year. We know they're coming. We just know whether they're this year or next year. I think that's going to depend on a lot of jobs numbers over the next couple of months. But it looks like they're getting pushed out a little bit, which explains, you know, the rise in yields a little bit here. But still, they're coming. And, you know, I don't think the bond market is fully priced in. I think we still have more room to run higher with cuts eventually coming, whether they're, you know, in a few months or 4, 5, 6 months. So I do think that there's more upside, room for bonds to run.
Dylan, can I get you into a long bond?
Not in a million years. My only relative position compared as it relates to the macro economy and the sort of most macro sense of the word is in that long dollar position. And by virtue of being long dollar, I'm short marginal expectations of rate cuts, which I guess would put me into some version of a short bond-ish position, I guess. But I wouldn't put myself there. I like my long dollar, not just on the absence of rate cuts on a relative basis, absence of a marginal rate cut, I guess, combined with the abomination that has been the Trump attack upon the dollar. And so I sort of let my bond position reside inside of the US currency without actually expressing it in the bond market explicitly, because I don't have the confidence to be long or short the bond on a fundamental level. I guess by virtue of being long the dollar, I'm short the bond on some derivative basis.
I suppose so. If you think that the dollar is being driven by higher yields, I wonder if...
Which I don't.
Right. So I wonder if there's a difference here, to Thomas's point, between what's going on at the front end of the curve and at the long end. So the way I structured this, and you can see that I have this on as of today, is through TLT, where you can see IV rank is only 4. So if ever there was cheap vol to buy, I mean, this is pennies. And so if you look at sort of where you are and you just say, you know what, if I did an at the money call vertical here, basically from where we are, 89, out to the next big pocket of liquidity, which you can see here. Obviously, there's some liquidity here, but the real meat is at 95, which not a shocker, really. That's right above here, above this swing high and into these tops. So 95 is just about here. So if you wanted to take the trip from here, where let's say this was the top of the range and you've pulled back into it, from here up to essentially a retest of whatever top this is, this high and that, somewhere in here, the risk reward on it is pretty incredible. I mean, at 168 to 432 max profit, you're talking about basically 2.5 to 1 risk reward because vol is so cheap. It's not a bad idea in my mind. And so I've put this on just as a trade, not because I terribly believe in the idea, but because the risk reward is so good and the vol is so cheap, and I can think of how this would work and why. Seems to be something to consider, and so I have it on now. I suppose if we're going to run this thing hot, then the place it should show up first and foremost is higher rates here. This is ZT, and you can kind of see it. It's sort of there. The move is there. We're kind of testing into here, and here's the continuous contract. You can see it a little bit cleaner. I wouldn't say it's a done deal that bonds are done going up here, but it does seem a little bit heavy. Whereas if you look at ZB, I think maybe on reflection, it makes more sense for this to be a pullback in a move higher than it does at the front end, especially if the Fed is going to be cagey about cuts next year.
I mean, do you have a strong bond position on beyond a marginal position? Are you prepared to put a meaningful capital behind a bond position? Are you, Thomas?
I'm not a meaningful position.
I'm not in a bond position right now.
Exactly. Are you in a dollar position, Thomas?
I'm short the Canadian dollar.
So you're long the US dollar by virtue of that.
Yeah, right.
Mm-hmm. Short gold.
Long gold,
Mm-hmm.
long gold.
Point is, there's nothing in the bond that attracts you to a strong position. Anybody.
Not yet.
Because
No.
who could know? Who could know? You got these rate cuts, but you have this sort of weird marginal increase in inflation, weird marginal increase in growth, bizarre super records in equities in the face of slowing growth and inflation, oddly weak dollar, which I think is the only reason the stock market's at records, because it's a dollar adjusted number.
Very well could be.
And I would think a stronger dollar ultimately means a weaker. I mean, that's why I like my short NASDAQ, long dollar, short gold. Although, why are you long gold, Thomas, at this level? Out of curiosity.
I'm just playing. So my gold position is for 40 days out. I kind of had it on to hedge uncertainty going through this. Obviously that's not working out today. But I just think ultimately gold makes a move higher as we go into some of this uncertainty into that year with deficits, things like that. It's just something I've been doing that's been working out all year. Buying either gold or silver. I mean, I've been switching between those depending on technical levels, but just staying long the metals in one form or fashion.
Has been your friend.
It's been friendly.
You're saying it's habitual.
Yeah. I mean, I'm doing that through long call spreads because usually we see volatility expand when gold moves up. I mean, I don't think we got that on the last move higher. The first time it, hasn't had that correlation with volatility in quite a while. So I'm not sure what that tells us. I'm not sure if that's a sign that, this gold move is ultimately maybe have topped somewhat. But I still have enough confidence. It would take a much larger pullback, somewhere under 35, for me to really abandon a bullish thesis on gold.
Mm-hmm.
I mean, the dollar. I do think the dollar is a threat.
Meaning a stronger dollar creates weaker everything.
Right.
Yes. It's an interesting thing here because if you look at what gold's done, it pulled back. It's not in the strictest of terms breaking down. So if this was kind of your line in the sand right here, you're sort of at it. So right here is your kind of range bottom, as it were, on where kind of the base for gold was. Now, Dylan, to your point, this is not it's not lost on me that this was the top of this range. You came and tested that right here, held it, then broke down. So we did take a step lower. I mean, that much is clear. There was a range here, it held, we tested it, we broke down, we took a step lower. But this now is perhaps a more meaningful sort of level. And I haven't gotten out of my long position yet, not because I don't agree with where you are on this. I actually do. I need to see this thing show me.
You want a little confirmation, as they say in the business.
That's right. I'd like to get it under here, and then I'm out. I've made my money. Thank you very much. And it's the same thing in silver. So if you look at silver here, very, very similar setup. So if you look at kind of where the logical, that's not it whatsoever. There's absolutely nothing logical about that line. If you look at what is in fact a logical line, let's say here somewhere, then we're kind of at this interesting bottom again. And it's the same thing as gold, where you had this range top, you are through it here, and you did hold it. I mean, like, this is pretty technically clean. You break down, retest, nope, retest, nope. Okay, now we're going down. You might even say there's a little give here, maybe something like this. But again, you're resolving lower. But this is an interesting sort of line in the sand here. So I'm still long this because Chris talked me into it, but I'm okay to hold it probably unless it gets down here. If it breaks down here, then the trade's wrong and I'm out. And I'm happy that I'm long dollars on the other side, because if the trade is wrong, then ostensibly the long dollar move will keep going and that'll be an offset.
I mean, don't you think generally it's well advised to blame any losing position on Chris at this point in time?
Absolutely.
Considering his,
if it's not working, the mere fact that he's not here to defend himself means that it is his fault.
I would agree with that.
I mean, for gold, you still have a lot of things that have been in place driving it higher that haven't really changed.
That aren't the Fed, yeah.
Right. I mean, central banks, they were big buyers of gold in 2024. It's kind of slowed recently, but they're still buying. I mean, the war in Ukraine, it doesn't look like they're making really any progress. I mean, I think that's putting a little bit of a premium on gold. Say you get some breakthrough peace negotiation. I think that's something that could, actually cause a larger pullback for the time being. But I mean, outside of that, there's still fiscal uncertainty. There's uncertainty with the Fed's independence. There's now more political uncertainty. I just don't see the trend really reversing without some potent driver that comes into the market.
Yeah. I mean, one thing that sort of sticks out for me, next week we're going to have the first look at S&P Global PMI data. And it's not the kind of loud release that a CPI number is, or NFP, or a Fed policy announcement, yada, yada, yada. But it is a very timely look at essentially where the dynamics of growth are. And the expectation, if we look at what the markets are looking for here, I mean, let's set the stage here first. Last go around, they showed that the U.S. economy is reheating. That essentially we're starting to get positive momentum back into the economy. And we see here, see if I can get this on the screen. There we go. So here's the U.S. composite PMI. I mean, we can see where the weakness is around the tariffs. And we can see that over July and August, the economy seems to be reheating back to levels that we saw at the end of last year, which is pretty heady in context. I mean, you can see end of last year was some of the highest we've seen in a few years. So looking at this should be interesting. The expectation is that there's going to be a little bit of a cool down. Do you think if we get a meaningful decline and all of a sudden the economy is like, whoa, these concerns that the Fed might have about a shifting of the scales is coming together quickly? Is that fast enough, Thomas, do you think, to short circuit this run it hot idea, or are we going to need to see something of greater substance?
I think you need to see a little more than that. So I mean, a lot of the weakness has been companies are they're facing uncertainty. They're not necessarily investing less. They're doing stuff to control costs. Like one of the first things you do is, you stop hiring, potentially lay off some people. But you don't necessarily stop investing in your core products or whatever you're selling unless demand drops off, right?
Right.
So if it depends what the numbers are driven by, right? If there's all of a sudden, more weakness in the labor market to which degree that demand starts dropping for services, which is the majority of the US economy, then I think that's where you get a little bit more concern. And I think you'd see a lot more volatility if that was the case. If it's a gradual decline, something that's, it's not going to head us into recession, but there's some weakness, it gives the Fed a little bit more appetite to pull those rate cuts back forward. I think the market would potentially rally on that.
Dylan, thoughts?
You're saying Thomas, the market would rally on what?
So if these PMI numbers drop considerably, it would depend on what they're dropping on. Is it some weakness in hiring, some slowdowns in orders, but the actual demand in the economy isn't dropping off? I think that would push up the rate cut bets or pull them back forward to where we get maybe 3 rate cuts this year. I think the market would rally on that. I think where it comes into a problem for the market, equity markets, is if you see this dramatic decline where you're getting layoffs with a drop in demand, and then you're expecting corporate profits to cool down a lot, then I think you start getting a lot more weakness showing through. I don't think that's the scenario we're going to see. I think the economy is going to remain.
You're saying that's a prerequisite to my NASDAQ sell-off?
Yeah, one potential.
Speculatively.
One potential, yeah.
So to that end, here's the GDP Now model from the Atlanta Fed. And again, we're far enough removed from these third quarter GDP numbers that the actual number that this talks about, which is a 3.3% quarter, is meaningless. We're too far away. But the slope of that green line does matter in the sense that it gives you a sense of what kind of data is going into the model. Because we just had a model update today, for example, with the jobless claims numbers and everything else that came out. The slope is up. So as you get more and more data coming in, I mean, sometimes this thing is revised daily, sometimes every other day, depending on kind of when the relevant data comes out. But it's revised in real time, as it were. And so you get a sense for the tone of the data going into the bucket. And the slope of the green line tells you the data is growth positive, at least as far as this bucket is concerned. And so if that's what it is, then it would stand to reason that at least for now, the market isn't getting the evidence that whenever eventually is, whenever sort of the overheat comes, that's now or that's here. You'd have to start to see some kind of substantive growth scare occurring for the markets to go, oh, wait, this is not that. And then maybe things really start to get unglued, at least in stocks. But in the meantime, it doesn't seem like there's anything that necessarily speaks that way. And it sort of makes you think that, yeah, maybe the metals haven't broken down yet, but if we're wrong about yields, if yields are going to keep going up, if essentially this idea that this is some kind of a thing to buy is wrong, and it turns out that actually yields keep going higher because we are going to run it hot, then it could be that at least 2 legs of the Radigan are already working and will continue to work. That is to say, metals will go down, the dollar will keep going higher.
I mean, the problem with the Radigan, as it were, is by virtue of the probably illusory and misguided validation of being right on the dollar and gold, at least for the day, is it lends me to the delusional belief that the NASDAQ must come around, which obviously it has no obligations to oblige itself to my madness. And so I'm not entirely certain as to what to do other than the fact to be satisfied with my long dollar, certainly dollar euro, which is kind of where I've positioned myself, my short gold by virtue of the GLD put spreads, and then my less satisfying short triple Q, which is obviously underwater after today's adverse reaction to my advocacy for its decline. I guess my point is it's sort of a trading lesson in the sense that just because you're right on, let's say I have three ideas. I have three ideas, right? Short NASDAQ, short gold, long dollar. Mm-hmm. Just because you're right on two of the three ideas doesn't actually mean that the third idea will eventually be right. In fact, you could be so wrong on the third idea that your rightness on the other two ideas could be rendered financially immaterial, which I'm fearful may in fact occur.
Well, I mean, indeed. I think I have been lucky in the sense that my ideas since the beginning of the year, sort of in the first 6 months of the year, my idea was short dollar, short stocks, and obviously short dollar worked and short stocks didn't. And thankfully, I made more on the dollar idea than I lost on the stocks idea. My idea from the middle of the year up through about now was long the dollar, long bonds, short stocks. And again, short stocks obviously didn't work, but long bonds did. And the dollar did start to bottom in July and hasn't overcome those lows. In fact, it seems to be going up again now. So that's offset my sins in the stock market. But that's not at all a given. You can absolutely lose more on the side that isn't working. And especially in a market that refuses to go down almost constitutionally and just does not want to give up but for some sort of obvious Armageddon-like scenario. Thomas, while we have you here, our resident commodities expert, what do you make of what's going on in oil here, if anything? I think one of the interesting sort of things on the board here continues to be this sort of stubborn standstill for oil. We talked about maybe it was attempting to get higher here. It found familiar resistance again, and so it's getting wedged back in. Do you think run it hot ultimately means a kind of cyclical oil rally, or this thing is just fairly valued and isn't going anywhere?
I still have my iron condor on. I'm going to continue to do that. I mean, it's worked all the way since June, you know. So I think it's going to keep working. You have conflicting factors. Crude oil stocks did decrease, you know, last week. We got a little bit of a rally from that this week. You know, we had the Ukraine drones attacking Russian export terminals and things like that. So I don't know. I think oil is kind of locked where it is without a signal that the economy is either going to fall off a cliff or go into, you know, a super strong part of the year. I don't really see much happening with oil. I just, you know, global inventories are rising. OPEC's going to be pumping more oil. At the same time, Russia's going to be exporting less. So I'm just playing the range right here. I'm going to continue to play the range. I think where you get a little defensive is where you get, you know, up around the recent swing highs and swing lows for oil. And, you know, that would be down under 60 or above 70. I think as long as you stay in there, I think it continues to trade in a range.
Before we call it a day here, one thing I wanted to take a look at is actually the Swiss franc, which is a recent addition on our futures menu here. And in particular, see if we can get the continuous contract. Here we go. So if you were going to play a dollar reversal higher, this is maybe one of the more interesting spots. So you had this attempted breakout, which has now failed. And not only has it failed, but it's failed in kind of semi-spectacular fashion. If you're a fan of candlestick patterns, that's a bearish one. And so if you were going to take a bet to essentially say, okay, maybe there's rate cuts in the US, but the dollar is clearly not correctly valued here, at least as far as the markets are saying, because the Fed was not as dovish as the markets thought. So maybe it's got room to recover, and it seems to be making inroads already. And looks a little bit more convincing than some of these other ones. I mean, the pound looks not bad. The Aussie looks not bad. Thomas, can I get you into a Swiss franc short position? Dylan, can I get you into a Swiss franc short?
Meaning a long dollar position versus the franc at the end of the day.
Correct.
Thomas, go first here. I'm up because my whole relationship is euro dollar, maybe yen dollar. I wouldn't even know where to begin to establish an opinion on the Swiss franc, other than they do have a lovely set of mountains and lakes.
And in fairness, it's very euro correlated. So what there is in the euro is very often the same thing as what.
And so I'm happy to be short the euro and not get myself mixed up with these mountain people.
Ilya, when I started working here, I was told not to trade the Swiss franc, and I haven't really
so
done
you
that.
continue.
So you know,
why were you told that, Thomas?
There was a couple people working here recently that were kind of burnt on that that whole revaluing of the franc a while ago.
Ah, yes.
Yeah.
God, I'm happy.
Think some unspoken individuals with a deal gone bad.
Yeah. So I've heeded that advice. I don't know. I mean, the franc, it's interesting to look at, but I haven't had really any appetite to trade it. When I'm trading the dollar, I usually do the euro, the yen, one of the majors, the Canadian dollar, the Aussie. So I stick there.
Why are you trying to suck us into your Swiss franc situation, Ilya?
Well, it's funny because I can say with some certainty that part of this amorphous group that Thomas is describing includes me. I mean, I was one of the people, surely, Thomas.
You're one of the individuals.
Yes, that forewarned against the shocking actions that the Swiss National Bank likes to take, and sort of the tender miseries of having your central bank be a publicly traded corporation and operate from that perspective rather than a central bank as such. And so the kind of decision making you get out of them is sometimes not what you would expect a central bank to do. Hence the catastrophic reval of Euro Swiss in 2015, which ripped many a face off in front of my very eyes. Thankfully, I had no involvement in that idea whatsoever. But it's certainly.
What brings you to the Swiss francery today, if I might be so bold as to ask?
What brings me to it here is it seems like the Swiss National Bank isn't a factor here, that this is just a reflection on the dollar is undervalued, and one could have a dollar trade here that's not mixed up in any kind of European geopolitical what have you, and is just a dollar play in a naked way.
Would you rather be short Swiss franc as a dollar long, or like why establish a preference to be long the dollar v franc versus v euro, v yen, v?
Oh, I'm short those two. I'm short those two. I think here the technicals are maybe a little bit cleaner. but that's about it. I mean, let's compare this with the yen, which is another thing I'm short. But this looks more like a range within which we still exist, and it's not quite as convincing. Although being short the yen, I think is a trade. I mean, it's a trade I have on. Interestingly, I have it on here on the Tasty FX side in spot. You can see here it's making a little bit of a profit so far because the 6J future I think is just way too big, and so I'm doing it in spot because it allows me a 10K lot position. It's smaller and more manageable that way. I might consider the same thing for Swiss franc, where I might put it on the spot side, and in doing that, kind of dilute various S&B shenanigans risk.
There's an important election coming up for Japan in October.
There is.
The one person that's running, I can't pronounce her name, is a big proponent of ultra loose monetary policy, right? Yes. There seems to be an interesting situation going on in Japan, and we'll no doubt talk about it next week. I'll just leave us with this idea that there does seem to be something like a trend emerging here for the yen, whereby the highs are getting lower, the lows are getting lower, and one might think that the path of least resistance is this way. But with that, overtime is out of time, so we're going to have to get to that later. Thank you, as always, gentlemen. This is our last moment together for this week for overtime, but I'll be right back for macro money, where we'll continue to pick apart where the dust is settling after this FOMC announcement, and I will see the both of you on Monday when we return.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Forbes called us best online for options trading. With stockbrokers.com, we're #1 for options and futures trading. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade. What's up, everybody? Check out my new series, Life Cycle of a Trade, where I show you my real-time trades with insights into strategy selection, adjustment mechanics, all the way to the closing order for all of the tastylive core strategies.
Delta, Vega, Gamma, Theta. It's all Greek to you. Well, guess what? Millions of people speak Greek, so you've got no excuse. Here's your alphabet. Theta is time decay. Time itself has value in the options world, and that value slips away the closer you get to expiration. Theta is how fast that happens. Tick-tock, time value drops. Delta is difference. How much does a $1 move in the underlying affect the price of the option? Long options have a positive delta because their value moves with the stock, and short options have a negative delta because their value moves opposite the stock. Gamma is get up and go. It's how fast delta changes. Gamma increases when the options start trading much more like the stock, like the closer to the at the money and the last few days till expiration. Vega is not a Greek letter, but it does start with a V, and so does volatility. Vega measures how much the options price is affected by the changes in volatility. Now you know your alpha, beta, gammas. Well, gamma anyway. Pretty simple.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
The first 24 hours after the Federal Reserve policy announcement have elapsed, and price action seems to be picking some directions. And what it suggests is a bit of a regime change for the markets. We're going to explore that here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we're going to take a look at what these markets are doing with this Fed announcement, because it does seem to be something of a change of pace with where the markets have been for the past several months. And see if we can't unpick what all of this gyrating means for not just what's happening in the near term, but perhaps for the path forward and the recalibration, as it were, of the market's lens through which it receives economic data and other news, of course, and what the reaction function is going to look like from here, as different from how it's worked before. So first and foremost, let's take a look at how the markets performed today. We can see it was decidedly a risk-on kind of market. Looking at Wall Street, S&P 500 up 0.6%, NASDAQ up just over 1%. Yields, however, higher. Gold lower. The dollar higher. Bitcoin doing its stocks plus a high beta volatility premium kind of thing where it's risk appetite with steroids, basically mirroring what stocks are doing direction-wise, but with a bigger swing. So what's interesting about this, of course, is one might have expected that if the markets wanted a dovish Fed, either stocks would be down and everything else would be as it is, or stocks are up and you'd see yields are lower, you'd see the dollar is weaker, you'd see gold is up. That is not clearly what's going on here. It is much more so what happened in the initial reaction. This is how markets closed yesterday. And we can see yields are up, gold is down, dollar is up, the euro is down about 0.3% here, as is the yen. Stocks are soggy. They're not nearly as bad as they were, as we discussed yesterday, with the initial post-Fed spike down, but they ultimately closed with some weakness. S&P off 0.13%, NASDAQ off almost 0.25%, yields up by a good margin. So just looking at the price action here, we can see the markets read the Fed as relatively hawkish compared to what it wanted. And today we see a change of pace. And it's stock markets that diverge. Yields are still going up, as they did yesterday. Gold is still going down, as it did yesterday. The dollar is still going up, as yesterday. The difference is sentiment. And not just, by the way, in stocks. Bitcoin, again, as a kind of avatar for sentiment on steroids, or risk appetite on steroids, same thing. Yesterday, stocks down, Bitcoin down. Today, both up. So what's the stock market telling us here, and why is it sort of changing its mind about its relationship with Fed policy expectations? Well, let's look at the statement here first. We can see some of the changes marked off here. Hat tip to Nick Timmeros there at the Wall Street Journal for this handy vision of the things that were adjusted. We can see some of the key things here are that recent indicators suggest that economic activity has moderated, job gains have slowed, the unemployment rate has edged up. So clearly we can see where the justification for the rate cut is coming from here. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. That's ostensibly where we get this rate cut. In support of the goals and in light of the shift in the balance of risks, we get the cut. And indeed, if we look at how Fed Chair Powell characterized this, we can see we get the same nod to slowing in the labor market and the shifting balance of risks, and then an explanation that tells us we're not worried or anything. This is a risk management cut, whereby the scales have tilted somewhat, and so we are going to make a small adjustment to reweigh our stance relative to the scales. Where if we have inflation and employment on the scales, then if they were tilted totally toward a focus on inflation and no focus on the labor market, now they've shifted a little bit in the direction of the labor market, and that's what we're going to do. Notice the comment here, Powell saying, I don't think we can say that policy no longer warrants a restrictive setting. That is to say, the Fed and Powell, as speaking for the Fed, still thinks that monetary policy needs to be somewhat restrictive, despite the weakness in the labor market. And that, of course, reflects inflation that's at a 7-month high. Last we checked in on CPI last week, and where goods inflation is at the highest in 2 years. Thank you, tariffs. However, we do get the sense that we still are working on the assumption, looking at what Fed Chair Powell is saying here, that the tariffs are going to be a short-lived thing, and so we get this maintenance move. Now, where things get really interesting is in the forecasting, because for a central bank that's cutting rates and saying it's going to keep cutting them, the adjustment in the forecasting is pretty hawkish, again, in relative terms. So growth expectations are revised higher here for all 3 years of the forecast, for which we have a June baseline. The unemployment rate, steady for this year, but for next and for 2027, revised lower. Inflation, mostly steady, but where there are revisions, they are revisions higher. And for the rates path, we do get a third cut that's baked in for this year, but still from, admittedly, that lower baseline, so not 3.9, which would be June's projection of 50 basis points in cuts this year, from 4.4 down. Now we're saying 3.6, but thereafter, still only one cut for next year, still only one cut for 2027. Now, how you arrive at 3 rate cuts here is a bit of a subject of its own debate. You can see here, there's an even split here almost between those people favoring 2 cuts or less, and those people favoring 3 cuts or more. And obviously, you get a very dramatic skew in the forecast here with this dot. We can surmise who that dot might be. But when we look at this, nevertheless, we get the 3 cuts, and they don't really surprise anyone because, as we've discussed before, the markets were already set for 3 rate cuts at least a week before this meeting. You can see that in the expectations. Here's the outlook for October's meeting. Right here is the week before today. So a week in advance of the Fed policy announcement, the probability of that second cut at that meeting is already over 80%. If we look at December, a little bit narrower, but again, the probability of a December cut after a September one, after an October one, over 80%. So really all the Fed has done here in saying, oh, there's going to be an extra cut, is give its blessing, as it were, for what the markets already anticipated. But the disconnect for 2026, the disconnect for 2027, that remains. And interestingly, what the markets have done is a kind of curious shift. So take a look now, and we see that for the rest of this year, this is from now through year end, we've got 37 basis points on the menu. So at least one more cut, and as we see, we're erring in the direction of a third as we just looked. For next year, we've come down somewhat, and now we're at 66 basis points. So obviously this reflects the 25 basis point move that we've already had, but notice from the kind of dovish outlook extreme that we had before the Fed announcement, which was 140 basis points in cuts between where we were prior to this week's meeting and the end of 2026, we are now at 100 basis points, give or take. In other words, we've moved more than just the 25 basis point cut. The outlook has become pointedly less dovish for next year. Now, it's still well in excess of what the Fed has, but the market clearly took a cue here and said, oh, so you're saying we're going to have hotter growth, hotter inflation, lower unemployment, and you're saying that means only one cut next year and one cut the year after. We think that sounds hawkish. We still think you're going to need at least 2 cuts next year, but at least directionally, the adjustment that has to happen here is toward a hotter economy. And so the relationship between stock markets and the Fed outlook seems to be in flux. Now, we've talked about this evolution since the beginning of the year, and perhaps we're at another one of these inflection points. We started the year with a growth scare. I mean, we can see this right here in mid-February. Stocks reach a top right there. So do Fed policy expectations. They hit a top of sorts. This is the least dovish of this year as far as the outlook for 2025 through end of 2026. Then we get this growth scare around the initial rollout of the tariffs until, of course, there's something of a crescendo with Liberation Day in early April right here, and both stocks and policy expectations hit a dovish extreme and start to correct. Now, by mid-May, the policy outlook is done correcting, and stocks have conveniently come back to basically the spot where the breakout right here starts to actually occur. And so they've erased all of this scare. And from there, so from here onward, it looks like stocks are rallying as the outlook for policy gets more and more dovish. And so it's very compelling to say, well, the reason stocks are rallying, and indeed we said this here, the reason stocks are rallying, or at least in part the reason stocks are rallying, is because the markets are betting that there's going to be cheap money that's coming down ahead. And what that's going to do is, obviously, make assets more attractive, because whatever risks there may be, they are eminently more digestible with cheap money versus not. And so what we see now is apparently this relationship has changed, where this right here is our most recent dovish extreme. And as we saw, again, looking over here, we can see the change here has been greater than just 25 basis points. The change has been essentially closer to 40. And so it isn't just that one cut has already occurred to move this line up. It's also that the outlook for next year has become less dovish. And so what you then end up with now is stocks going higher at the same time that the policy outlook is getting less dovish. And what that seems to suggest is that after the Fed, the markets have reconsidered this relationship. Pointedly, they've not reconsidered it with the dollar, where the dollar has essentially shown itself to be probably right going all the way back to early July, where you can see here the dollar starts to bottom while the policy outlook still gets more dovish, and it seems to be holding that bottom here as the policy outlook has started to shift the other way. And so a turn in the dollar certainly seems to be a compelling idea. And again, over the course of the past 2 days, here's the initial response from markets: stronger dollar. Here's the follow-on: even stronger dollar. And so it does seem like, at least here, things are working as you might expect. But stocks have apparently decided, well, we're going to run it hot. The economy is just going to have to get more inflationary. Because clearly, the Fed is easing into a situation where it is saying we're going to have faster growth, we're going to have higher inflation, we're going to have a lower unemployment. So we're going to let inflation stay elevated, as it were, at least until it starts to meaningfully hurt consumption and meaningfully show up in growth data such that we know, oh, okay, we're already on the other side of this thing. But in the meantime, stocks apparently are saying, well, if the Fed is going to run it hot, then so it is. And the relationship between stocks and the policy outlook needs to change. Now, maybe this is going to evolve again. We still have a huge triple witching event tomorrow, tons of option expiries, tons of contract rollovers. And so maybe we still need another 24 hours for the dust to really settle in earnest before the end of the week. And maybe this is going to change for next week. But for the moment, at least, it looks like there is a meaningful difference now. And for what it's worth, looking at the way that the U.S. economy has been performing, it does portend some sort of a reheating. Looking here at the Atlanta Fed's GDP Now model, it is surely too early to make much of it as far as the actual forecast for the third quarter. Those numbers aren't going to be coming out for quite a while. So that this model currently calls for a 3.3% annualized rise in GDP for the third quarter. That doesn't mean much of anything at the moment. But that this is a nowcast, that is to say, it's adjusted in almost real time with incoming economic data, that's telling, because we can see this green line that approximates the GDP forecast is very pointedly sloped from the lower right, or from the lower left rather, to the upper right. That is to say, it's pointed up. The tone of the economic data getting fed into this model clearly seems to be growth positive based on what is going on here. And so with that in mind, the market can basically presume that things are going to get run hot until they're not. And for the moment, we don't have the kind of weighty economic data on the menu that would say, oh, here is a meaningful risk. Now, we're going to have the S&P Global PMI numbers next week. That'll be an interesting view on growth. We'll see what that looks like. But otherwise, next week's U.S. economic calendar is kind of soggy. There's really not a whole lot that's there. There's some home sales numbers. There's a revision of second quarter GDP data, just to give you a sense for how far behind that data is and how slowly it's going to take us to get to looking at the third quarter numbers. Not until Friday next week, when we get the PCE report, are we going to get something really meaty for this U.S. growth outlook. And we're going to have to go into the beginning of the following week as we start to look at the first kind of days of October, when we're going to get ISM data again, we're going to get NFP data again, and that'll maybe give us a different perspective. But for the moment, the Fed's sort of asserting of a hotter economy seems to make sense. And stocks seem to have concluded that with that in mind, they're just going to change the way that they behave relative to Fed easing. And they're going to read the absence of conviction on that easing not as a bad thing, but as indicative of an economy that doesn't need it. And that seems to have imbued stock markets with fresh strength. Now, positioning wise, I I am compelled by the price action to stay a little bit short the S&P because it did not clear its swing high from 2 days ago, despite the gains. So I am begrudgingly holding this until tomorrow to see what happens because it failed to hold above that high today. I am similarly still long the metals because despite them being weaker, they haven't crossed their Rubicon yet. They're still within their congestion range. But I have also loaded up on dollar longs. So yesterday I was a bit straddling the fence here, short the euro but long the pound. After this Fed announcement, I flipped the pound position over. I am now short. I am also now short the Aussie dollar, short the Canadian dollar, and looking for a bigger dollar bottom to take hold. I also nibbled a little bit on the long side of bonds, thinking that if the market is going to start to think that whatever rate cuts and whatever overheating and growth reckoning might come will give us rate cuts just later in size, then perhaps we're due for a little bit of a twist in the yield curve where yields stay relatively anchored at the long end, but maybe rise up a little bit at the front end. So because the volatility here was dirt cheap with 4.3 IVR, I took a little bit of a stab at trying to pick a bottom in the bonds and see if maybe that is a part of this run it hot until you can't kind of narrative. And that is macro money for today, as well as for this week. We're here Monday through Thursday, so we'll be back with you on Monday. In the meantime, I'm also writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money returns on Monday. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
I have made a deal with the devil and I'm long UNH.
What's your most controversial market opinion?
Well, my newest phrase of the year is until proven otherwise, which basically means buy every dip because they've been gobbled up pretty quickly. And even like the tariff stuff, at the bottom of the tariff stuff, I was like, ooh, maybe things are different. And now here we are at all-time highs, like 2 months later. So I think you still got to keep your size in check, but I think the dip buying is here to stay.
Well, I mean, I already told you my UNH trade. I have made a deal with the devil and I'm long UNH. So I think that is pretty controversial. I don't know a lot of people that know about that stock, let alone trade it, let alone want to be long it. And so I feel like it's a whirlwind of just heinous attitude that has to be to the upside now.
If you missed the live show, here's our cherry on top yearly recap.
So, we're doing the show on Friday, and the bat, he's doing the show in the morning, then he's going away afterwards, right?
Yeah.
He's all packing up the car, he's doing his stuff.
RV.
Packing up the
Packed
RV.
up the RV for a 6 to 8 day trip. We're supposed to be there about
4
48
days.
hours.
I bet him $20, and I said, you'll be in a hotel by either the first night or second night.
And then I vociferously stood up for you.
Of course you did. You should have, because that was the smart move.
I appreciate you. You're
yeah.
Saturday morning, I look at my phone, and it says Venmo, $20.
I almost had to pay him $40 because there was a little stipulation. If I didn't sleep there one night at all, I'd have to double the bet. I almost had to send him $40.
What happened?
See what happened?
Here, what happened was
we're driving up there. It's absolutely beautiful. It's like sunny as can be.
You were tweeting pictures.
Oh, yeah, it was
Like a
beautiful.
girl
It was
on
beautiful.
Instagram, you're like, I'm here in the woods.
Absolutely beautiful. Absolutely beautiful.
Amazing.
It was gorgeous. We were gonna make a slight right-hand turn. We got about 10 miles to go, and up ahead there's like this dark cloud, and it's raining. It started getting muddy, and dogs are getting all muddy. Wife's having a little problem. Bugs are everywhere from the rain. And I realized at that moment that my wife was not a camping gal.
That's a surprise.
So at 6 o'clock in the morning, I pulled everything out, closed everything up, shoved everything underneath, and I was home. We actually left because we did the show at 10 o'clock in the morning. Let's say we left at 10:30. I was home at 10 o'clock in the morning the next day. Look at him.
You were just
Jumped in my pool, looked back at my house, and I said, why would I ever leave? Why?
He was going to go fishing, catch.
He's hurt on this one.
Muskies. Some bass.
Very quiet.
I left Friday at 10:30. I was back Saturday at 10.
AM?
Yeah.
You didn't make it 24 hours?
No.
Who broke down?
They all did. They all did. I rented a boat for Saturday, but the boat was broken. It rained for 5 hours. When we got there, it was...
Now the RV on rvtrader.com.
No.
Yeah.
Whoa, wait a minute. How do you get to Florida now?
I don't care anymore.
Oh my God. First of all, I'm sitting in the captain's seat. I've never been invited to come sit in the new captain's seat. But what I'm concerned with is the size of these screens. And then he's still doing this.
Snow, let's take a look.
They did not hold that rally at all.
Phil, you got a partial.
973.75.
I'm looking at this like I have to move my head to get through the top, the top symbols. I thought he had like a little computer and he was getting down.
He hasn't learned that he could swivel his head. He has to see the screen. He has to go like this to me. And then, you know what? Money goes to money. You did it. Good job out of you.
Yeah. I just drove with him twice. Now I'm really concerned that I was just in the car with him for 2.5 hours. Okay, I need help understanding. This is the largest monitor that I've ever seen. I have to move back in order to see everything. And somehow when you're on air, you're looking at this, you need some help.
Nope, I got everything fine. The problem is I just have a lot to do. You see, because in your job,
oh, here we go.
Really, all you have to do.
Get the full scoop by checking out the archives at tastylive.com.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Global markets never sleep. Explore them with Forex on Tasty Trade. Get in on 80+ Forex pairs, 24 hours a day, 5 days a week. FX marks the spot. Trade it on Tasty Trade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come